Let's go ahead and talk about mergers and recording them. I hope the glare from the overhead projector isn't too bad. I hope this is the best way to get around my atrocious handwriting. In any event, let's go ahead and assume that the big company acquired little company in an acquisition be accounted for as a merger. Little's trial balance on the date of acquisition was as follows, and we have all of our assets and liabilities at book value and at fair value. In addition to their recorded assets that are on the trial balance, Little Company also has an in-process R&D with an estimated value of $20,000, as well as customer lists worth $10,000. Both of these items were expected to have a 2-year remaining useful life. And I want to record the acquisition, first assuming Big paid $200 in cash, and then secondly assuming Big paid $140,000 in cash. Now, there are a couple things worth noting here. First and foremost, what we're essentially buying in a merger is a bundle of assets and liabilities in intangible attributes. When you buy a used asset, the historical cost to the seller and the book value to the seller are irrelevant. So basically, your first order of business is going to be to say, look, all of these book values are completely irrelevant. That gives me the opportunity to sort of consolidate my board space here. So bear with me a second as I wander off screen. Go ahead and get rid of my text out there. Okay, so this is the bundle of assets and liabilities that Big is acquiring in this business combination. Now, again, these are simply the ones that are actually on Little's balance sheet. In addition, there might be unrecorded unrecorded assets, more likely unrecorded intangible assets. And the question then becomes, under what conditions can we record these intangible assets, things like in-process R&D and customer lists? And basically the rule is we can record intangible assets in a business combination if they are either separable, that is, if they can be separated and sold apart from the business, or if they arise from a legal or a contractual right. One thing that never survives a consolidation, and Hardy, you may notice that the goodwill here has nothing in the form of a fair value. Goodwill is not separable. Goodwill cannot be sold separately from the business. It doesn't arise from a contractual right. Goodwill never survives a business combination. We might find that there's new goodwill recorded in its place, but the goodwill that Little had on their balance sheet does not survive the business combination. So let's go ahead and add up what the fair value of our net assets is. On the asset side, we've got 170, 225, 235, 263. On the liability side, we got 123. So net assets that are on the ledger are $140,000. In addition, we're also acquiring some in-process R&D that's worth $20,000 and a customer list that's worth $10,000. So we add those intangibles, and the fair value of the net assets being acquired is $170,000. Now, one more thing about these intangible assets. Normally, when we have R&D expenses or R&D costs, we expense them as incurred. If we acquire another company that has R&D projects in process, we go ahead and recognize the value of those as an asset. The idea is that when we bought Little, when we decided on the purchase price of either $20,000 or $140,000, when we bought Little, part of what we were buying, part of our sort of mental calculations in terms of how much Little is worth, is based on this in-process R&D. That is something that we bought as part of this transaction. On a similar note, this is in my eyes. On a similar note, we recognize in normal circumstances, we recognize contingent liabilities, but we never recognize contingent gains and contingent assets. If Little had filed lawsuit against some competitor for patent infringement or something like that, and they were fairly certain they were going to win, they say, look, we think we're going to get this big settlement from the court system. Little itself wouldn't be able to recognize that as a contingent asset because we don't recognize contingent gains, we don't recognize contingent assets. When we buy Little, though, part of the purchase price that we determine includes our expectations regarding that lawsuit settlement. So we might also, if it were, in this example, if there was a contingent gain from a lawsuit that Little expected to win, we could record that as an asset as well, even though in normal circumstances we would never record a contingent asset. In any event, the fair value of the net assets is $170,000. Under scenario A, we're going to pay $200,000 in cash. So we're paying $30,000 above and beyond the fair value of the net assets, and that's going to be goodwill. Again, for some reason, we're willing to pay more than the fair value of the net assets. There must be some sort of intangible attributes that make the whole worth more than the sum of its parts. The sum of all of those intangible, unidentifiable, inseparable attributes is going to be goodwill. So let's go ahead and record this acquisition. Basically, all we're doing is we're going to record the acquisition of these assets, and we're going to record the assumption of these liabilities. So, and there are two things I put in here just sort of for old time's sake. Let's go and record this stuff. We're going to receive cash of $10,000. We're going to get receivables with a fair value of $28,000. Now, again, to consolidate my board space, I deleted the book value column, but the book value of those was $30,000. I assume that's the face value. So we're acquiring receivables with a face value of $30,000, but again, we all know that when you have receivables, you don't expect to collect all of them. So we look at the likelihood of collecting the receivables, and we say, look, we think we're only going to collect $28,000. That's the fair value. The $2,000 difference, of course, is the allowance for bad debts. So we're going to go ahead and record $30,000 of receivables, and on my credit side, we'll go ahead and record the allowance for bad debts. We record the acquisition of the inventory, the equipment, and the patents. All at fair value, 55.90.80. And we also are going to be acquiring, we're going to record this goodwill that we're creating. Okay, I forgot our two intangible assets. I was just thinking to myself, I need to go delete this line to clean the board up. We're acquiring some in-process R&D. And we're acquiring a customer list. Okay. Oops. Okay, in terms of the liabilities that we're assuming a $20,000 account payable. And another thing, sort of for old time's sake, recall that those bonds payable had a book value of $100,000. They got a fair value of $103,000, so of course we're going to put the bonds payable in at face value, and we're going to have a $3,000 premium on bonds. Okay, what did we... How did we? This is the bundle of assets and liabilities that we acquired and assumed. What did we pay to get this stuff? We paid $200,000 in cash. Okay. So again, the moral of the story as far as this is concerned is when we make an acquisition, the subsidiary's goodwill does not survive the business combination. Intangible assets can be recognized if they are either separable and or arise from a legal right, like a leasehold or something of that nature. Okay, let's go ahead and go on to the second scenario. The second scenario was going to be the exact same merger, but rather than paying $200,000, we were only going to pay $140,000 cash. So we have the same assets being acquired, but now, for some unknown reason, we're able to acquire the business for less than the fair value of its net assets. In this case, rather than having $30,000 of goodwill paying above and beyond the fair value of the net assets, we're going to have a $30,000 savings. And currently, and this is something that bothers some people, we're going to simply call that a gain on a bargain purchase. Now the idea that you can have a gain or income from buying something really rubs a lot of people the wrong way. But that's the current standards that we adhere to. So let's go ahead and record this stuff. And I'm going to clean this up. Instead of listing all the assets and liabilities individually, I'm simply going to record net assets. And again, the fair value of net assets was $170,000. That was all of the recorded assets at fair value, plus those two off-the-books intangibles, minus the fair value of the liabilities. We paid $140,000 in cash. Again, basically we need a plug figure to make this thing balance. That $30,000 plug figure is going to be a gain on bargain purchase. Again, this should be an extraordinarily rare occurrence. If you do find yourself looking at a situation where it looks like there's a gain on the bargain purchase, you really need to be careful and confirm that all of those asset fair values and liability fair values that you determined are in fact accurate. You need to be sure that there aren't any undisclosed liabilities which might have reduced the market value of the firm. Again, we assume that this isn't a capital markets transaction, but we assume markets are relatively efficient and that there are a large number of buyers and sellers, and there aren't, you generally can't buy stuff for less than its fair value in an open market. In some cases it does happen, but you really need to, see a lot of red flags when you think you have a bargain purchase. Okay, one last thing I want to throw in here. Normally, and that's the issue of indirect acquisition costs. Normally, so in the case of a business combination, legal costs, accounting costs, due diligence, finder's fees, all of these various costs that are associated with entering into a business combination. Now, normally, when you buy an asset, and again, we're essentially buying a bundle of assets and liabilities, normally when you buy an asset, you record as part of the cost of that asset any and all necessary and reasonable costs to get the asset to the place of and condition for use. So, normally if you're buying, if you're buying 1,000 shares of stock, the commission on those shares of stock is rolled into the cost of the investment. If you buy equipment, the delivery charges and sales tax and installation costs are rolled into the cost of the equipment. And so you could say, look, if there are these indirect acquisition costs, legal costs, accounting costs, things of that nature, shouldn't they simply be rolled into the cost of the acquisition? And the answer is no. Indirect acquisition costs are expensed as incurred. So if we spent $20,000 on legal fees, we would record, legal expense or, business combination expense and cash. Now, this might not seem too outrageous in this scenario where we're buying a specific bundle of assets, but this is also going to apply if we buy a controlling interest in another firm's stock. So a company has 100,000 shares of stock outstanding. We buy 80,000 of those 100,000 shares, so we're an 80% owner. We have control. In normal circumstances, when you buy shares of stock, any commissions and things like that are rolled into the investment cost. In a business combination where we're acquiring control of another company, all of those commissions and so on would be expensed instead as an indirect acquisition cost. Okay, one last thing to note. Again, let's see if I can go ahead and undo some of these steps I did. Your disembodied voice off the side. Okay, here's our initial information again. And one thing that was never seen again were the original common stock and retained earnings accounts. Basically, that represents the ownership interest of the previous owners, right? When we buy a little company, and again, basically this equals all of that, right? Net assets. When we buy little company, the previous ownership interest is extinguished. The only equity holders are the owners of big company. Big company has its own common stock, additional paid capital, retained earnings, or if it's a sole proprietorship, its own, big capital account. But basically it has its own equity accounts. These equity accounts represent the ownership interest of the previous owners, which has been extinguished. Okay, that's enough of that.